All right. Good evening, everyone. Welcome to the Hope session for October 13th. I am Tyler Wain, the founder of Hope Financial Solutions, and tonight we're going to be talking about types of investments. Just to quickly give you a background about myself. I am happily married in 2016 to my wife, who was born and raised in South Africa, then immigrated to Canada. That's my son, who was born Easter Sunday, 2021. So he's just turned 18 months and is transitioning to daycare. So we have him going a couple days a week, and he's starting to settle in. So we're relieved on that. And just a bit about me. So I worked for 14 years in the corporate world, mostly the consumer packaged goods, and slightly in the nonprofit sector, Hospital for Sick Children and municipal government, most recently. But earlier this year, I really felt called, and I see a need in the market to help educate people on financial knowledge and helping to build that capability and practices and habits, just giving support. So I started my company, Hope Financial Solutions, and I was trained through Dave Ramsey back in 2000. I did the financial coach master training, but I also did another course this year from High Performing Coach. So I finished that certification this year. And I serve in the local community on a charity called Church Out Serving, which is really focused on relieving food poverty in the community and helping to build an inclusive community. And I'm based in Waterford, Ontario, which is about 1.75 hours southwest of Toronto. But if you hit traffic coming out of the city, then it's more like 3.5. But I try to avoid that. So tonight, as I mentioned, we're going to be talking about types of investments. This is a very high level discussion. So just to kind of set the stage, as a financial coach, I am there to help with planning, education, of course. That's what we're focusing on tonight. So what are these investments? Where can you put your money? And helping you with planning, how much should I be putting to retirement and what might be a best account. But ultimately, the specific investment decisions and recommendations, I always recommend working with a certified financial advisor, ideally a fee for service, because then there's no underlying motive to try to sell something. I mean, we're all human. It may even be very subtle and not overt, but if I get a commission from selling a certain type of item, I'm likely going to push that and just look at it in a more favorable light. So I always recommend a fee for service, which is where you would pay that person and they're there to help you. So just quickly, if we look at the types of investments, and we'll dig in a bit as we go through them, but so if you have extra cash and you're saving for a home or retirement, you can either keep it in cash, or I say cash like accounts. So something like a cashable GIC. So if you've been following along with me a bit, I talk about emergency funds, other funds. I keep my emergency fund in a cashable GIC, because if it just sits in cash, I'm not going to make as much interest. A cashable GIC, I can make a bit more interest, but still access it if I need. So it's all about, and we'll talk about this shortly, but it's about risk and reward. So I'm trying to get as much reward, but I don't want to take as much risk, because that's an emergency fund. It's insurance for me. So cash is really, you just put it in an account. Maybe there's a few other products, but cash like is I can access it when I need. The second type, bonds. So there's government and corporate bonds. There's many other types, but those are the two main classes, if you will. So like there's Canada Learning Bonds, but just a Canada government bond, savings bond, right? So there's different par values. Par value is the amount the bond is worth. The actual price is far more complicated, and that's where your financial advisor would be best served. I can talk a bit about the theory, but it's very detailed and hard to get into. So quickly, so it's better to say, if you assume the par value is 1,000, right? So you purchase this bond at a coupon rate, which is the rate you get paid each semi-annually or annually, whatever the terms are. So you get some interest, and then when it matures, you get that par value back. Corporate bonds are so a government bond is a government issuing it. Could be federal, could be provincial, could be municipal, whatever government there is. And they would raise those funds. So the reason they do it is to raise funds for their needs. Ideal or typically infrastructure, but it could be for other things as well. Just they have cash needs, right, to run the country or jurisdiction they're in. Corporate bonds, similar, but in this case, it's a company backing it, not a government. And if you're looking like Standards and Poor's, Moody's, there's all different rating agencies, so they rate these bonds, and they're rating them on the quality, which ultimately is assessing the risk, which we'll touch on in the next slide. Stocks, I'm sure many of you have heard about stocks. So at a simple level, a stock is a share in a company. So a company, let's say it's worth $100 million and they have 100 million shares. If they issue it all in equity, that would mean $1 a share. So there's 100 million shares out there. If I buy 10 million shares, then I own $10 million or 10% of the company. I don't. Typically what we actually purchase is fractions and minuscules. But if you do any kind of investing or any looking at stocks, you can see the number of shares outstanding. So that gives you an idea how many shares are out there. And if you multiply that by the price, that's the current value of the equity of that company. They don't have to issue it all out, but that's the basis of a stock, is a share in a company. And there are different types. There's voting and non-voting. Typically, you'll see a voting. So when you purchase that stock, you're now a shareholder of the company. So you have a right to vote and make your wishes known to the board of directors at their directors' meetings. So you actually have a bit of a stake in it. If the company grows and does better, your stock price should go up. If it declines, it should go down, all else being equal. Much more complicated, but that's basically what a stock is. It's ownership in a company. The next group, the fourth one I have, is mutual funds. Now, mutual funds, it's a type of investment, but there could be a variety of items in there. So a mutual fund could have cash, it could have bonds, typically would, stocks, any combination thereof. And when you get into stocks, there's growth stocks, international stocks, dividend stocks, all kinds. So a mutual fund can have any combination thereof. But it's called mutual because what you're doing is you're actually, there's a group of investors that are putting their money into a fund, and there's typically a fund manager, and that fund manager then invests. Now, the amount that fund manager takes is called their fee, the management fee, or if you're talking technical terms, it's the management expense ratio. And when I'm working with people, again, I don't recommend specific mutual funds, but I will always tell them, from a planning point of view, ask what the MER, or management expense ratio, is, and ask for what the historical returns are. Because that fund manager is critical. They're the one making the calls on those investments. They have a team beneath them, but they're the ones ultimately making the call. So if they've consistently outperformed the market, I would say look at the return and the return they're getting and take off the MER and compare it to another similar investment. And that way you get a gauge, am I getting what I'm putting in? Am I am I getting my return that I could, right? If they're charging a high MER and the returns aren't there, you may not be doing so well, right? And in the simplest form, there's a mutual fund. There's also something called exchange traded funds. So they have much, much lower MERs because what they do is they actually mimic a fund. And you could get them for the tech sector. So maybe they mimic the tech sector of the Toronto Stock Exchange, in which case all the funds that make up that Toronto Stock Exchange in the proportion that they're there are in that fund. And each day it gets adjusted based on the percentage that it's worth, right? So it's automatic. There's no or very little human judgment. And that's why the MER is lower, because ultimately, essentially a computer could run it. So you'll get a low MER, but they're not going to be making the decisions that a fund manager could. So you have to look at the two. And ideally, if the fund manager is making better returns, then it might be worth what they're charging. But always ask, what's the MER? And the last group, which is a wide array, is called derivatives. So you can have any combination of like the derivatives are things that come off of the top four, more number 2, 3, and 4, bonds, stocks, mutual funds. Some things you can think about, there's stock options. So you can buy calls, which are maybe only a couple bucks, but they give you a right to purchase shares at a specific price, but they also have a timeline on them. So I could purchase the right to buy Toronto Star at, I'm just making this up, $50 by the end of December. And maybe it cost me $2, but you have to look at the share prices to see where they're at. A put is the right to sell that price at that price, right? It's a contract to sell it. If it doesn't work in my advantage, I just let it lapse and I lose my $2 that I put in to buy that option. If the price falls and I have the right to sell it at a certain amount, then I can use that option as long as it's before the end of the contract. So a bit more advanced, and you definitely want to talk with an advisor if you're not experienced. A bit trickier, but it can minimize your upfront investment to give you a higher leverage or higher return because you're not investing as much money up front. Other things, hybrid products. So there's like convertible bonds. So they're a bond, but then they have the right to be converted to shares. There's a whole variety. There's there's other cash type items, like it's just any combination thereof. There's like, you can trade commodities, in an example. That's not so much a hybrid product, but it's another derivative, right? Where it's just it's trading contracts for wheat or oil or copper, whatever it may be. So lots out there, but in general, the first four are kind of the structure, and then the fifth is all different options from there. But their value, they're called derivatives because their value is derived from their underlying investment. So maybe like a stock option, the value of it is derived based on the underlying stock and how it moves. Okay, so that's the type of investment. And now just quickly to touch on this. So it's all about risk and return, right? So if you're looking, and this is what you want to talk with your financial advisor on, and right, the risk is the chance you lose what you invest. So you put money in, it doesn't work out, you lose, and that's the risk. Or it goes down, that's also risk. The return is what you can earn on that investment, right? And there's always a trade-off. They're always connected. And if you haven't seen, I've used the phrase a bit before, but this is what I always tell people: Tanstaffel. There ain't no such thing as a free lunch. This was first coined, and I first heard this by my university professor, finance professor in third year. And he said, remember, there ain't no such thing as a free lunch. So if somebody's promising a whole bunch of returns and no risk, I would really start to ask some questions and dig in. Because if that's true, then why wouldn't they want it all for themselves? Right? There's always a risk, and it's about balancing the two. So there's no right and there's no wrong. It's about your own preferences, your own trade-offs, your own desires and goals. But you have to always judge that, and you want to try to maximize your returns while minimizing your risk as much as you can. I'm just going to move out of here and show you a quick 90-second video. This is from the Finance Academy. It's on YouTube. That's the link if you want to watch it on your own, but I think it really demonstrates the risk and return paradox or connection. Okay, so as you saw in the video, risk and return, for those non-financially savvy people, just remember, right, the example of asking somebody out that you like. So there's a risk you could get turned down and suffer a little bit of a hit to your ego, or there could be a good return and a nice benefit if that person you're interested in, you like, says yes. So it's the same everywhere. There's a risk and there's a return. So always think about that. And if there's one thing, always remember to ask, what's the MER, or the management expense ratio? Okay, so that's a quick summary of the types of investments. Next, in October 27th, the next Hope session, I'm going to go through sort of investment accounts, so where you can put the money. You'll see there's registered, which have tax implications, and non-registered, which are, you still get taxed, but they're not special tax treatment. So that will be October 27th. You can register on Eventbrite using the link below. And remember, it's always a short 15, 20-minute talk, and then we'll go and open the floor to open questions. So if you have things burning on your heart or things you want to wonder and ask about, it's open floor. So always happy to see how we can help you achieve your dreams. Once again, Tyler Wain. And if you go to my website as well, www.hopefinancialsolutions.ca, you can always book a call with me. Links directly to my calendar. So you just click that and you can book a 50-minute call or a 30-minute, whatever you want, and we can chat that way. So look forward to chatting with you and see you on the 27th. Have a great night, and now I'll open the floor to questions. Take care, everyone.